All right. Welcome, welcome, welcome. We have all our guests filing in here. Chris, nice to see you. We have a few more people showing up here. We have Edward Monarchik, our asset manager and also our director of development. And we also have our developer, Michael Holman. There they are. Boom. Right on cue, my friend. Okay. So everyone, welcome. Happy New Year. Happy 2025. I'm really excited. Viking Capital had a blockbuster 2024. Chris, how did you feel about last year?
No, it was fantastic. We got four deals acquired. We got Peoria started. You really couldn't have asked for a better year in challenging times.
Great. Okay, now we have the full gang, guys. Welcome everybody. So an amazing year, 2024. There's been a lot of uncertainty out there, but I think we at Viking Capital were able to capture some of that and utilize that to our advantage by being able to get deals at really promising basis, and we're able to get nicer, newer products. So I'm excited about that. I don't know if any of you got stuck in the winter weather. I was in Cancun a couple of days ago. I couldn't come back. So I was quote unquote stuck in paradise because of the snow, but I know the East Coast is still digging itself out. How about you, Michael Holman? I know you're based in Utah. Was there a lot of snow out there?
It's actually been a unusually warm winter so far. So temperatures are cooling, but yeah, I'm looking out my window right now. There is no snow in any of the valleys. Bunch of snow in the mountains, but in where I live, there's only been a few flurries. Park City's gotten a bunch of snow lately. And up on our benches just got a bunch of snow this last weekend, but where I'm at, it's actually very little snow right now.
That's interesting. And then Ed Monarchik is our asset manager, our director of development at Viking Capital. Ed, you're in Atlanta. How you doing out there?
Cold for Atlanta, very cold.
Okay, cool. Hey, I want to make sure the microphone works, everybody. I want to make sure that the messaging and chat box works. If you have any comments or any questions, go ahead and put it in the chat. And then if you have any Q&A, if you want us to answer at the end, please use the Q&A button. But right now, please put in where you're calling in from, where you're zooming in from. I'd love to see where you guys are all watching this broadcast from. Okay, Boise, Idaho. Awesome. Welcome. We got Arvin from Seattle, Randeep from Irvine. We got Amber from Springfield. Awesome. We got someone from Peoria. Awesome. That's great. Look at that. All over the country. Chris.
Yeah, no, absolutely. And it reminds me, a lot of our investors are out there on the West Coast. For any of you that are dealing with the wildfires in LA, I hope you all are staying safe out there and, not being affected too bad.
Yeah. All right, guys. Well, I think it's going to be a fun evening. I'm going to try to keep it tight for you guys. I'll respect your time. Thank you again for joining us in this evening. We're starting up the new year strong. We have this beautiful deal we'd like to share with you, and it's actually a little sentimental for us at Viking Capital. It'll be our 30th offering to our investors over the years, and so we're really excited. We're really proud to share this with you. We're also going to educate you on the state of the market, state of development, state of the economic cycles. We'll also talk about how the new presidency is going to affect real estate. And so stay tuned for all of that information. So it's going to be educational. It's going to be informative. We're going to also share with you the details of this latest investment. And at the end, there'll be an opportunity for you guys to answer questions. I'm ask us questions, and we're here to answer them for you. And we'll try to keep all of that tight in about 60 to 75 minutes. Okay, so let's rock and roll here. A little bit of introduction. My name is Vikram Raya. I am the CEO and co-founder of Viking Capital. We started this company in 2015. My partner, Ravi, and I, next slide, please. We started this company as two busy professionals who were looking to create passive income and non-clinical income in our lives. And, we know that many of you guys have primary careers. You guys are lawyers, doctors, you're Silicon Valley investors, you guys are entrepreneurs, or you're working for a corporation of some sort. And obviously you invest in stock market, perhaps in crypto and other things, and you're looking to diversify your investments into things such as real estate. And so that was our initial reason why we got into this business in the first place. And so from a small boutique firm that was essentially based in DC that started operating in Atlanta, we've become a national premier multifamily private equity real estate firm where we really have a nationwide presence. And honestly, the reason why people want to invest with Viking is because they want cash flow, they want the tax advantages, they want equity they want diversification, they want appreciation, and they want a team that's trusted to handle, these kind of transactions. And so, next slide, please. Speaking of the team, we've really grown over the years. This is our 9th year, or the soon to be our 10th year in operation, and we've grown the team appropriately to where we have essentially aces in their places. So what started off as just me and Ravi, and a couple of folks starting this company, to now we probably have an extended team of almost 30 people. So we have acquisitions, investor relations, marketing, operations, finance, all the research, the analysis, all that's needed to really serve our investors. We're an investor-centric firm, so we want to have that feel of an institutional company or institutional investment vehicle, but we want to have that high touch that's sometimes missing from a lot of those bigger corporations. And so, again, my background is non-traditional. I'm a cardiologist. I trained at Georgetown. I really loved what I did, and I did real estate sort of as a side hobby or a passion. But over the years, it just simply grew to something more than something like a side hustle, and I really wanted to pour into it. And over the years, as I found other successful businesses, I slowly transitioned into being full-time in real estate, and I've really enjoyed it. It's an amazing journey. We've had some nice accolades along the way. We've recently become Inc. 5000. We've been able to deploy over $400 million of private equity over our deals, and it's really an amazing to see our investors grow their wealth and grow their capabilities over these years. Next. Along the way, I've had a lot of help. One of the key people on our team is Chris Parinello. He's our Vice President of Investor Relations. I'm gonna let him introduce himself, and you can learn a little bit about how he's been critical in helping educate investors and get them very comfortable with our investments.
Yeah, thanks, Vic. Just a little bit on my background. Spent the last decade in private equity, from hotel development to international capital raising, and other multifamily firms. At Viking, I head up the investor relations department. Our team is going to be the foot for the investors that are with us, that are in our other deals. You all know me already. But for those that are new, we are the conduit to help you not only understand how these deals work, if you don't already know, but also to build the reporting, and help you really be part of the process.
And without having operations, without having execution on these properties, and we are presenting to you our first development deal, but in reality, if you look at our team's experience, it's not our first at all. And that's why we brought on early last year Ed Monarchik when he joined Viking Capital. Ed is a consummate professional. He's been around. I'll let him state his experience in a second, but he has 9 figures worth of experience in development and asset management, and that is why we brought him here. So Ed, please share a little bit about yourself.
Thank you, Vic. It's great to be here with everyone this evening. Obviously, I'm Ed Monarchik. I'm the Director of Asset Management and also helping out as Director of Development here at Viking, helping get this up and running and established. We plan to partner with JV partners like Overland that you'll hear about tonight with Peoria, and launch a development program. The JV development program presented today is a structure that I've implemented over the last 10 years. So I have a lot of familiarity with it. My experience in development is rather lengthy, and looking at these numbers, it kind of makes me feel old, but I like it. I have developed all throughout the Sun Belt, garden style, mid-rise, high-rise, and mixed-use development, and I've developed myself and also using this JV structure. I'm super excited to present this opportunity to you today. In real estate, it's all about timing, and we feel the development timing for the cycle is right now.
Awesome. And then the last member of our team I want to present to you is Michael Holman. He's the Vice President of Development and Finance at the Overland Group. So me and Michael have been friends for many years, and we've talked about potentially working together. But I had to make sure Viking was at the right level and the right trajectory to take on essentially not necessarily a new asset class, but a new way of looking at multifamily. And I felt like that late last year, early this year was the right time. Almost 10 years in the business of perfecting value add multifamily. I felt this is the right time to get into development, and I wanted to be with someone I trust and someone who has years and years of experience and who's active in this market and can understand both what happened in the pandemic and post-pandemic and things like that. And so Michael has been phenomenal to work with. I'm going to let him share about his track record, his experience, and why he's excited about development.
Yeah, thanks, Vic. And good to be with all of you. I've been in development for in my 8th year now. I'm a CPA by trade, came over to Overland Development and dove in headfirst. So we've been developing, growing quite rapidly. So we've been in business for about 45 years now, started by my father, Ken Holman. And nice to have his guidance throughout this, the last 8 years and continue to have that. But grown to where we're now about 400 million in the development pipeline right now, with about half that under construction and half in pre-development. So it's been an exciting ride, and exciting to be able to finally be able to partner up with Viking Capital after a lot of conversations and many years of knowing each other.
Yep. And then why don't you tell us a little about some of your current projects in the development and things you've completed?
Yeah. And the nice thing here is you're going to see a lot of these are in Arizona. So we're in the same market, same type of assets. One that is a couple that I'll just highlight is that one in the top middle, the Falls at Crisman Commons. That's one that is actually receiving C of O right now. So we've been leasing 2 buildings. We have TCO on the first building and are leasing and getting C of O on the second building for the entire project. So 240 units in Mesa. Another one that's similar to this, a little bit bigger, but in a similar market, is that Avondale Commons Apartments that we're currently under construction with 324 units. And we've been under construction for about 2 years, and we're going to be fully wrapped up here in Q3 of this year. So really exciting to see some things coming together on that. Other than that, we've just been developing a whole bunch of stuff. I won't bore everyone with every single asset, but we've done some hotels, some storage, and a whole lot of multifamily, which has been our bread and butter.
Okay, fantastic. All right, guys. And so, people ask us, hey, who is a Viking investor? And I say, it's changed over the years, but overall, these guys are hungry, they're ambitious, they're successful. People all over the country. Now we have investors now in every state. For a while, we didn't have Lego or somebody.
So evasive.
And what they're doing is they're interested in becoming tax efficient. They're interested in creating multiple streams of income. They're interested in working with a trusted partner, and they are not passive. They are interested in the projects. They're smart. They're sophisticated. They learn and get educated, but then they don't mind being LPs, and getting the benefits of all the benefits of being an LP. So that's who a Viking investor is, and that's usually who's on these calls. So congratulations for being on this call and taking interest in your own financial future. And let's briefly talk about portfolio and performance. So during this last few years, there's been some volatility in real estate. I'm not going to lie about it. It's been challenging. But one of the coolest things I'm proud of for our track record is not necessarily all the assets we bought, but despite buying all these assets, we've never lost a single investor dollar. And at this point, we've never made any capital calls. And we really are focused on capital preservation. And so that's what I love about us. It's good to play offense, but it's also good to have a very good defense. Next slide. This will be our 30th project, close to over 6,000 doors, 1 billion of assets acquired. On our exits, which we've exited, we've had about a 24% average IRR. And obviously, here's some notable publications we've been featured in. And for those of you new to multifamily, why is this even interesting? Why is this hot? Why is this where institutional money like the KKRs, the Apollos, the Brookfields, why are they going after this asset class? It's because there's profit at the sale, there's tax advantages, tax mitigation. It's a hedge against inflation. In fact, one of the inflationary measures uses rent as part of the number. Over a longer period of time, this asset class does appreciate. We're actually in a housing shortage, so there is consistent demand, especially in different parts of the country, like Phoenix. Rent growth on average over a 10-year period is between 3 to 5%. There's long-term stability. This is a necessity class. This is not a luxury or a want class of asset. And obviously, we've talked about cash flow. So a lot of good reasons to consider multifamily. Okay. And I don't think I need to belabor the issue. Right now, if you want to buy a house, it's still quite expensive. I know they've cut interest rates, but that really hasn't translated into mortgage rates being cut. And with insurances being elevated, with hurricanes on the East Coast, fires on the West Coast, and all the other challenges, it's still quite unaffordable to own homes. Next slide. And with this millennial Gen Z and this new type of crowd that's coming into the rentership, home ownership market, 50% of people are saying, hey, I'm choosing to rent. I could buy, but I'd rather rent. Reasons, because it's, the high cost of home ownership, we've talked about it, lower maintenance. People just don't want to deal with all the hassles of home ownership, and enhanced flexibility if their work relocates, remote working. So there's a lot of reasons why we're seeing a trend toward more multifamily renters. And this statistic, I was hoping, I've been saying something similar to this for several years. Unfortunately, there's still a shortage. And, for you as investors, you guys get to take advantage of that, because supply and demand mismatch, because there's a supply and demand mismatch, rents in general will increase over the years. And I'll show you graphs to support that. And there will be rent growth, there'll be demand, and there's not enough supply right now to meet it. And that's why people like Michael Holman and Ed and Chris they're coming together to create housing for people, for people's demand. And this shortage is going to continue till 2035, over the next 10 years. It's not a one and done problem. Again, this is also showing you that how vacancy is starting to come down, market rents steadily climb over the years, and there'll be an opportunity when we exit in 2027, 2026, 2027, 2028. Okay, so I'm going to hand it off to, I believe, Ed.
Yes. Why new development? We believe the time is right now for the next development cycle, and there are a couple factors that are leading indicators of that cycle. One would be a stable but decreasing interest rate environment. There's been record low permitting over the last few years. The absorption of supply that came online from the previous years, the past 3 to 5 years, has been absorbed and has been delivered into the market, or is almost finished being delivered to the market. And the lack of supply to meet demand for housing in the United States that Vic just talked about a minute ago. And then lastly, timing. It takes about 2 years for a project from conception to delivery of units. So if we identify a problem, it still takes about 2 years to really get everyone into the market. And we feel like we're early in the cycle for this. This slide, yeah, you can see here that multifamily development has slowed down. It's looking as if it picked up a little bit. I would anticipate it'll plateau out there a little bit, but it'll stay historically low for the next year or so. And that is one of the reasons why now is the time to get into development. Next slide.
Yeah, I think this slide is really where you can really see it, Ed, in terms of, people say there's an oversupply issue. What would you say to that based on what we're seeing here?
Absolutely not. If anything, we're undersupplied. We got a little bit out of balance back in 2023 to 24. That was when everyone could get a lot of financing, and a lot of construction went underway. But I'd say for the last 2 years, it's been extremely difficult to get financing. It's been extremely difficult to entitle and get a development deal out of the ground. So the shortage of housing that has historically been there we haven't even really made a dent in it yet. And I would say those charts on 20, 26, 27, and 28, if you look at the light blue line, the absorption, I think it's going to be higher than that, because I think the assumptions in this are low on the growth rate of the economy.
Yeah, so if you take a mental snapshot of that picture, guys, this is really our business thesis right here. And Michael, I'm sorry, Chris, go ahead, and then I'll let Michael back on the slide.
Yeah, adding clarity, and love Mike's take on this as well, because I feel like the picture is really clear. So, during the time when interest rates were basically, the Fed's fund rate was at 0, I'm sure developers like Michael were out there saying, wow, look at how low cost this capital is. We're going to develop as much as we can. Let's line up our equity. Let's take this land we've been holding, and probably had record years during those years. But then as the Fed changed their policy and raised the federal funds rate up, the faucet kind of turns off. And, you have institutions that don't want to place capital. You have, debt lenders that are charging a lot more, and you can see the spike and then the fall. And the normalized rate is probably closer to what it is in 2019. We have this interesting moment in time where a lot of people aren't able to participate right now. And, due to the structures that we use and the investor base that we have, we're able to get out ahead of this before people can really start building.
Absolutely. I think, Michael, do you agree with all those sentiments?
I mean, yeah, absolutely. I mean, because even if you look at Arizona, right, according to the Arizona Department of Housing, there's 100,000+ housing unit shortage in the coming years. And so it's kind of interesting is you go through this multifamily cycle, people will take a screenshot, a snippet of what's happening, and you get all these institutional investors that are all concerned, right? Oh no, look at all this new supply. Is all you have to do is expand that snippet a couple years in each direction, and you start realizing, oh my goodness, like there is a huge supply demand disparity here that can and needs to be taken advantage of, right? And so, but people get so focused on that snippet, and that's the key with what you're seeing here is if you just start expanding from the snippet of what's happening, last month, you really start seeing this picture, and it kind of makes me think of that. What is that investing adage, right? Be greedy when others are fearful, and fearful when others are greedy. And institutional investors are historically very bad at that. They're only greedy when everyone's greedy, and they're fearful. They're extraordinarily fearful when everyone else is fearful. So I think this lays it out pretty well, and your comments were great.
The next slide, please. Okay.
All
So
right.
here's the reasons why multifamily is a great development, and I'm going to let Ed walk us through this.
Oh, sure. It's a 3-year hold period, so it's a quick turnaround relatively on an investment. We typically build it and lease it up to stabilization, which is 93% occupancy, and then sell. And when you sell, the buyers are diverse, such as REITs, pension funds, private REITs, etc., which leads to increased pricing and lower cap rates. Redeploy capital faster. Obviously, that's related to the 3-year hold period, which we would hope you would redeploy with us, that you'll be very happy with the results. Core asset stability, core product, brand new product, it always has lowest risk in the market. Lower risk, one of the things I do want to bring up is that the cost risk is not, I wouldn't say eliminated, but the majority of it is eliminated because of the way the deal is structured and bought out prior to construction, so that you have a GMP or a guaranteed max price contract with the contractor. So we're not subject to the fluctuation in costs. So we know our costs. It's not like a condominium deal where you go in and your costs change and you've already sold out. It's we know what our costs are. We know the timeline to build, and that equates to a lower risk profile. And obviously we are developing to the millennial appeal. So you'll see later on, we have some units dedicated more towards efficiency. And then we also have some really unique units that are townhome units here, that are more for the folks that want that home feel environment. So we're catering to both here. And higher return potential. Typically, developments have a IRR and equity multiple that is superior to acquisitions. That's mainly due to a function of the shorter holder period, but also due to these other factors that we just talked about.
Okay, great. Awesome. And so we'll proudly present our latest project, guys, our 30th investment offering. And this is a picture of Peoria right there. It's Peoria Gateway. This is a 200-unit complex in going to be first coming online at the beginning of 2026, located in the Phoenix MSA market. And this is my slide. Okay, great. So then why do we love this deal, right? We love this deal for multiple reasons, but here are some of the main ones, right? The prime location, its connectivity. It's an A-class asset, right? A+ assets, hyper-connected area. Peoria is a very progressive neighborhood. It's in the path of progress. Really, now that Phoenix is sort of built out and Scottsdale's built out, and now Mesa and Gilbert, and now so things are moving toward this Peoria area. And we'll show you some of the evidence of that in subsequent slides. But this is really one of the top areas that you want to be in. And there's not that much supply coming online when we get our certificate of occupancy. It's very competitive in terms of our costs for building this. In fact, our rents being new are competitive with existing properties that are like several years old. There's obviously the development partnership we have. They have a proven track record. They know how to do things on cost, within budget, on time. And that was very critical for us to choose our development partners. There's low risk fundamentals. We've been studying the economics, the data, the MSA, the migration, the demographics, and development market cycles. And really, we found the sweet spot here with the low risk fundamentals. And again, we really believe in supply and demand and how the economy works. And with low supply coming online, by the time this gets into launch mode to occupancy mode, there'll be not much competition, and the absorption will be pretty rapid. So plus we specialize. We have a developer who specializes in building. We specialize in leasing and managing, and so the combination is perfect.
Well, I think this is me. Offering summary. On the left here, we have the project cost at 63.315 million. The total debt, which is 70%, 43.915. Whole period of 3 years with total equity of 19.4 million, of which Class B would be 12. Reserve class 5, and GP equity from Overland 2.4. As Vic said, we have 200 units. Projected completion is in 2026. Average unit size is 957. That's a good blended rate. That's about right for historical averages. 15 buildings, 3 stories, surface park, 331 units with some carports. High class amenities, which Michael, feel free to jump in here because you're more in tune with the actual specific unit features, but very high-end amenities such as clubhouse, fitness center, cyber cafe. You just saw the resort-style pool, grilling area, the club room, dog park, gated entrance, and pickleball
And
court.
guys, I don't know if you guys play pickleball. I used to make fun of people who play pickleball, and now I've become one of them. And so, we are catering to this generation. There's going to be some retired folks over here. There are young millennials, but yeah, pickleball courts, like everything will be electronic. There'll be a tech package, I'm sure. So Michael, why did you choose this level of features and amenities, and how do you see this as serving the tenant base?
So the amenity package we selected for Peoria, it's really fun because it was a combination. It's kind of a blending, right? We've done some stuff that was class A plus plus plus, right? Where you just throw everything in the kitchen sink in. And Peoria is nice because we were able to pack a ton of those A plus amenities into almost like this value package, right? Which was really nice, right? We didn't have to build 20 pickleball courts, could build 1 pickleball court. We could keep a smaller pool, but make it really nice, right? And those are the things that we were able to design with Peoria Gateway, with the space that we had, that made it a really high value project. And every development that we do and bring people into, and all of that, amenities is what sells your building, right? And so we always err on the side of nicer amenities, because I mean, if you think about it, whenever you're walking around a building, and if anybody's ever rented, right, what's the first thing you do? You're looking at the pool, you're looking at the gym, you're visualizing yourself using those things. And so that's really how we came up, is we have our standard amenity package. We were able to pare a few things down, increase a few things, but it's really meant to serve those residents and provide, it's almost like a mixed use community. We do a lot of mixed use as well. And so when you have a pickleball court and you don't have to go to the park for the pickleball court, right? It provides a sense of community. You have friends that'll meet on the pickleball court at the regular, 10 p.m. every single Thursday night after the kids go to bed or something, right? And it provides a sense of community.
All right, Ed, can you walk us through the business plan there?
Sure. Let's see, a 20-month construction timeline. It would be permits, just for everyone's knowledge, are expected any day now, I believe, Michael. It could be tomorrow, it could be a week, but it's imminent. Construction is projected to start in March sometime. Focuses on, we just talked about the features. We'll begin marketing in month 14. We'll probably market a few months, 3 months before that, the actual marketing. But month 14 is when the first building is anticipated to be delivered. And then from there, there'll be a delivery schedule, which will, to the eventual final CO for the whole project. We are going to partner with a proven property management company. We have 3 in mind, of which we'll select 1, which will help us with making sure that we meet the market appropriately, which we believe we are. And obviously lease it up to 93% occupancy within 18 months post-construction and sell.
Awesome. Very good. Let's go to the next slide.
Yes. Well, we talked about delivery being 2026. There's the units, average size. The rents here, that's the rents at lease up. So it's $2.14 at lease up. And you'll see on the bottom right there, as in today's market, It's $1.99 per square foot or $19.06 per month rent. So we are in line with existing rents. One of the things to note on the unit mix here, I like this unit mix because you have, what is it? You have 16% of the townhome units, which cater to that specific sub-market. And then you also have the 24% of what we call the junior, but the efficiency units, which cater to the millennials and those looking for smaller spaces.
Hey guys, I love all the chat in the chat box, and then there's also Q&A. So if you have a formal question, please drop in the Q&A. We'll definitely hit those up. If you have any comments or you need any help or support or any things, you can put in the chat box. But feel free to use those. But if you really have a proper question, try to use a Q&A. That way it's easier for us to like find the questions. And we're gonna have a Q&A at the end, so don't worry. I want to make sure we answer all your questions. And I'll use this as a moment to, if Amir, if you can drop in the book a link. Book a call, guys. Our team is on standby. We have our full team ready to go. We think this is already going to probably, fill up very quickly. So I'd love to get you guys to book a call. I want you to ask us all the questions you have, the tough questions, the easy questions, the weird questions. We want it all. And then we're going to just process all of them and educate you guys, make sure you understand everything, and then help you guys make a decision. But let's keep going.
Yeah, so this is me. So for those of you who are familiar with Viking, typically we have a 3-tiered equity structure with Class A, B, and Reserve. Obviously, a development deal isn't going to have tenants, so there isn't going to be cash flow. So that Class A class is eliminated. But you still have, two solid classes that are structured in the same way. With Class B, you're getting a 7% preferred return and an 85-15 profit share. The minimum investment being $50,000. Reserve class, you're getting preferred terms for a higher initial investment. So you're getting an 8% preferred return, and your profit share is shifting from 85-15 to 90-10. I love this slide because this gives you a chance to look at the capital stack. Right here on the left, you can see $43.9 million is going to be debt. You have $2.4 million that's going to be provided by the general partnership, which is, Viking and Overland Group. You have $12 million is what we anticipate in Class B, and then you have $5 million in LP reserve. One of the questions, and we're going to cover it in depth later on in here, was revolving around 1031. One unique piece about this deal is that due to it being a development deal and the land already being locked up and in place, we can accept up to $5 million of 1031 funds. So if you're one of those people that has recently sold a property and is looking for a 1031 opportunity, do reach out, book a call like Vic mentioned, because those spots are already about half full and they run out pretty quick. Moving to the right of this slide, total capitalization, debt, and equity appear at the top. And then, the details that everyone's been waiting for, the projected returns. For Class B, you're looking in that 3-year hold period of a 1.8x equity multiple, a 28% average annual return, and a 23% internal rate of return. I saw another question in there. I'm going to go ahead and take the opportunity to answer it. The difference between AAR and IRR is IRR takes the time value into consideration. And to Ed and Mike's point when they were talking earlier about how a development deal usually produces better returns than an acquisition, it's because of that shortened time frame. So if you put your money at risk for a short period of time and you get the same equity multiple, you're going to have a huge IRR. And that's really usually what folks, especially institutional folks, sophisticated folks, are searching for. Average annual return is just taking the total return you make and dividing it what the percentage is that you made year over year. Reserve class, so you can see that shift from 85-15 to 90-10 is getting your equity multiple up to 1.9 from 1.86. Your average annual return is going up to 30%, and your IRR is moving 2 points as well. So the returns are great, but we built this slide to kind of help simplify things so you can see that equity multiple and you can see what this actually means for the money that you put in place with Viking. So with the Class B investment of $100,000, you're going to earn $80,000 of additional funds. That's going to be broken up into cash flow and return at in this deal. There's no cash. It's going to be basically your exit at disposition, along with the return of capital. Reserve class is going to give you $450,000 of value creation and your return of principal for a total of $950,000. These are great. And, in addition to these sensitivity tables, one of the things that we always do with our acquisitions, and we did the same thing with the development deal, is Ed and I spent about an hour and a half with one of our 1031 investors, and we went through the model cell by cell, explaining everything to him, explaining how everything works. We recorded that conversation, and he's allowed us to share it with folks. So do reach out to my team, book a call, ask for the performer review. We have that ready to go, and we'll be able to send that out to you. This is one small piece of that performer review, which is the sensitivity analysis. So one of the big factors that's going to affect whether we hit our projections, underperform, or overperform is going to be where the prevailing cap rates are for this class of building in this area when we exit. And a lot of that's going to be determined by the broader real estate market and what's going on. So in most cases, a Class A brand new building in a market like Phoenix, in a strong path of progress submarket like Peoria, you would look at 4.5 or 4.25 as far as a cap rate to exit at. We still think that's very possible. We usually take the middle of the road route, and we want to be extra conservative, and that's what we want to promote to you. We're not going to be extra aggressive here. So what this is showing you is at our modeled rate of 4.7, you can see the returns that we're projecting and how we came to those. The performer review will give you all of the specific details, but this is going to show you just what the fluctuations in exit cap rate, which would be controlled by the purchase price, will do to your return. So you can kind of see where your floor is and where your ceiling is. The next slide is going to do the same thing for reserve class. And I will hand it back to you, Ed.
Okay. Obviously, the renderings look fantastic. What a beautiful garden style property this is going to be. As far as debt financing goes, here we have the loan principal, basically 70% of project costs. We are currently securing that right now. We are out in the market to get that. These are what we've managed to accomplish so far. 70% for modeling purposes. It is an adjustable rate. Actually all construction financing is an adjustable rate term. It's usually a 3-year term, but it'd be full term IO. We have a blended rate of 8%.
And the interesting thing is we have the option of we have a total of 5 years of loan capability. Our goal is to exit in 3 years, but it's nice to have that flexibility just to necessarily time the market to if there's any delays in construction, anything. It just gives us a little bit of flexibility, but our goal is to exit it, ASAP in 3 years.
And the other nice thing about that the loan that's used for construction deals is you can structure a 5-year loan to get that safety, like you just mentioned. But if you sell in 3, you're not going to be hit with yield maintenance or defeasance and have a huge cost. It's really making you make a decision on whether you want to exit in 3 or 5.
Okay. We want to, again, show you the actual value creation and the actual hard costs and things. So go ahead, Ed.
Yeah, this is one of my favorite slides because it really simplifies what's going on here. There's the finance side to it, and there's an art side to creating something from nothing. We basically, for 63 million, 63 and a change, we come out, we sell it for 89.7. We create 26.38 million in value, 131,792. Essentially, we create 42% increase in value by creating a rental income revenue stream, cash flow stream from ground up. It's one of the reasons why I love development, and I love this slide because it really simplifies what we're doing and just boils it down. Site plan, this is an overview of the way it's laid out. You can see the pool and the pickleball right there in the middle. You see the clubhouse there with the different color roof. It is flanked on the outside there by the townhome product, and the smaller interior would be for the smaller efficiency in the 1s and 2s.
And just for our investors, guys, what's around this site? Can you go back to the previous slide? Can you just give the team, the investors, and everyone else who's listening, this site that's going to be developed? What do you expect it's going to be around here, Michael?
Yeah, so currently what you have, if you're looking at this on the top end, you have retail behind there. There's dentist, restaurant, things like that. Over on the left, right adjacent to it, you have a restaurant and a chiropractor. And then over to the right is some older retail that's kind of ripe for redevelopment. In fact, I'd love to buy that property and redevelop it. But you have a few things, dog pet wash. There's a church over there and some things like that. So really what you have all around is you have this retail, but it's really in this redeveloping area. I mean, if you look at it, we shouldn't even be able to build here. This was a grocery store, an old grocery store that ended up getting demolished. And we just came in. It's the only piece of land available all around here. But everything is kind of going through this resurgence phase, right? I mean, you have a brand new performing arts center that's a stone's throw away. I mean, you can see it clearly sitting on the side. It's just on the other side of the street. And you have a lot of these things that are happening around. I mean, every single building is either getting refreshed or rebuilt all around it. And so it's pretty cool to see that happening, that resurgence here in this area.
So it's really the path of progress as we're talking about. Okay, great.
Absolutely.
And this is going to be the anchor property. When I went to go visit the site, I noticed that there's like a high school system that's across the street. And then you kind of go in and you see that this retail exists, but nothing really looks up to the quality of what this is going to be. Like the city must absolutely love Overland Group for building this property in this area because it's really going to jumpstart the redevelopment of that area.
Yeah, we've worked really closely. I mean, all the way. I've personally sat in the mayor's office, had multiple conversations with him and city council members as we were getting this entitled, way back when. And we worked this was very much a public-private partnership. I mean, to the point that the mayor was taking buses of city council members to the site to show him what he was thinking and angles and how high it should be and how that affect. I mean, they were really involved in this process, and we were really grateful for that because we think that it's a better product because of that partnership. But you're exactly right. I mean, and they're a big driver on what's happening in this area and the redevelopment that's happening here.
All right, let's keep going. We have a lot more to share with these guys. So,
all right. Well, it's me. I'm going to be quick, unless anybody has anything to jump in. But I mean, we talked about the amenities. I'm not going to go through all of these. Awesome amenity package. It's going to serve the residents really, really good. One thing to kind of note here is wherever we can, we want to have some ESG initiatives. And so what we've really tried to add on to this one, in addition to all our standard low E windows, everything like that, we're going to put solar panels on the parking canopies, which can power the common areas in the buildings. That's an efficient but impactful way to start trying to implement ESG wherever we can. So going through some of the renderings, this is inside the clubhouse. What you can see is clubhouse, we always want our clubhouse to be a little bit of a wow factor, right? So just beautiful. I mean, modern, you have wood accents, so really beautiful. Another thing that I love about this is as you walk through the clubhouse doors, people don't think it's important, but I'm going to tell you it is people walk through those doors, they have a perfect sight line to our pool, our pickleball court. That's why we put these big windows up. That wasn't done just for design. That was intentional. We do that on purpose so that when a potential resident walks through the door, they see a leasing office right next to them, and they see amenity after amenity right on the sight lines. More of the clubhouse. So you can see we have a theater room. This is one of the most exciting ones. Everybody loves the theater room. So the second we take people in there, I mean, they're envisioning, whether they're a gamer or they want to watch a Super Bowl there, they're loving that. And you can see here right behind on the picture on the left, you can see this is as you walk through the front door, kind of at an angle. And so you have your leasing right next to you, and you're going to have sight lines all the way to this beautiful amenity package all the way going through. And this is that amenity package. So here you can see the resort style pool. We always dress these up and they look really, really nice. In fact, all the ones that we're doing are just looking amazing. We like to add some of these cool features like this double-sided fireplace that you can see here. A lot of our properties lately have been there where you can see it from both the outside of the clubhouse and in the club room. So really, really thoughtful and purposeful on the design. We have a really good architect, FFKR, who's in Utah and Arizona, that helped design this project, and they did a fantastic job. A lot of value.
So I want you to both, Ed and Mike, just discuss why you chose this unit mix and how that's important for the tenant base.
Yeah, so I'll start, and then Ed, I'd love for you to jump in on this. I mean,
Absolutely.
Ed kind of alluded to it before, so I'm just going to hammer it home, right? The beautiful thing about this unit mix is the variety, right? So we have these one bedrooms that are split up in between junior and standard one beds. So your junior one beds are nice, but they're providing a component of affordability to an area, Arizona in particular. Affordability is a huge issue, right? Just being able to afford anything. So being able to come in with a smaller but thoughtful and well-designed junior one bed, it really lends itself to those who are needing affordability. And then as you go across that variety all the way to townhome units, 3-bedroom townhome units, that's where you're capturing those families and roommates that want, their own garage. They want more space, but they want the amenities that come with living in an apartment.
Awesome.
No, that was very well said, Michael.
Thank you. People don't tell me that very often, Ed. So I'll take all the compliments I can get. So more pictures. I mean, the pictures are beautiful. They speak for themselves. I almost feel like I'm degrading from the pictures. I feel like we should just sit in a moment of silence and let everybody, view the pictures and let the pictures do the talking. But the renderings are great. So the floor plans. This is one I will spend 2 seconds on. What I will say is these are some of the most, these floor plans, we spent a ton of time on these. And the reason why is we felt like they were an extremely good balance of efficiency and quality, right? So to point out some of the things that we're thinking about is we're designing these floor plans, for example, right? When you're thinking about a new development, you're thinking about things like every single door, right? But you better believe that one of the things we do is we count every single door because every single door costs $250. So if we have 12 doors or 6 doors, you add that across 200 units, that's making a huge difference, right? And so what you're going to see is you're going to see things are really efficient. Things like the doors. I mean, you look at like the 1 bed, 1 bath. There's like 5 doors on that entire unit, but you have a lot of thought throughout the entry. You used to have a walk-in closet. You have multiple accesses into a bathroom. And so you're getting these really efficient units that are functioning really well. They're really functional. And so that's one of the things that we're really proud of as we put these together is that combination of efficiency and functionality. And then the townhomes. We love variety, right? That the variety is the spice of life, and you don't have one tenant who only wants at least one kind of unit. And so having that variety helps a lot. So we have the 2-bed and 3-bed townhomes, whether you're just looking for a little more space like a 2-bed, or you got a family and you got 2 kids that got to sleep somewhere, 3-bed's perfect for that. Okay, on the rents. So this is where we're sitting at today. And what you're going to notice when we're positioning this property, right, and is Ed and Vic and Chris and I have all been working together on this, and we've been looking at rent comps. This is something that we track constantly because it's not changing as much as it was a couple of years ago, but it kind of ever adjusts and changes. And what we love about this property, right, based on the location and where it's situated, we're able to build a Class A facility. But like Chris said, it doesn't necessarily mean that we want to be top of market. And so by positioning ourselves here, you can see we're clearly not the bottom of the market because new product, we're never going to be the bottom of the market. We don't want to be the bottom of the market. But there's room for growth here. I mean, I'm willing to bet that we are on a product that we're delivering. We're going to be able to compete with things like products like the Lotus and products like Alta North Central. But we've given ourselves a buffer for some conservative underwriting to hopefully be able to capture some of that upside.
Not to mention that those are the rents today. This isn't going to be going online for a couple of years. So those rents are probably going to be 4 to 6% higher than they are today. So the spread will be even larger.
Yep, absolutely. So timeline. The biggest thing here that I kind of want to point out, and people can kind of read through this, I think there's 2 really important points to focus on. Number one, nobody's entering here at the front end of this. We've owned this property for almost 2 years. We've been working on it for 3 years, right? So there's a lot of background behind getting to this point today. I mean, there's entitlement work. So to be clear, like, project is fully entitled. Permits are coming any day now. That's the first point. This is on the tail end. The second point here is we're starting construction in about 6 weeks, 6 to 8 weeks. We'll be shovels in the ground. I mean, that's how. And if to understand development, I mean, like Ed said, you're talking 2 years a lot of times from the time you go under contract for a piece of land to the time you're put a shovel in the ground. You know, that's a long time. We spent 2-3 years worth of work on this. And so to get to this point, you're really at the tail end. Entitlement risk has been completely eliminated. So we can build what we want to build. What we're showing you is already been approved by the city. They want it. In fact, I had the city planner, side note, I had the city planner text me last night saying, hey, we're so excited about the project. Like, let me know if you need anything. That in itself is unique, right? To have a city that's so excited about it. But what you just need to know is we're really on the tail end of here. So as we raise the equity, get the debt finalized, I mean, we're going to be shovels in the ground. Construction teams are mobilizing, are getting ready to mobilize. On-site teams are being set in place. Build the thing in 20 months. We are going to start leasing earlier because the plan is we will be bringing on the townhomes. The goal on this project is get to leasing as quickly as possible. Best way to do that is come out of the ground with the townhomes first, because those are the shortest time frame to build. So we build those first. That's what gets us to start getting some rent in. That way we're renting and leasing up while we're still under construction. And that does a lot, right? That helps you on debt. That helps you build up a war chest. So a lot of those things are really good. And then, like Ed said, we get 36 months in, and hopefully market's in a place we can sell this thing.
Okay.
Go ahead, Chris.
Oh, is this me or is this?
Go ahead, Chris. You can just go with this.
So we have close to 32 questions in the Q&A, and I want to make sure that we're respectful of everyone's time. We're going to go through the submarket details in Peoria, but I want to go through them pretty quickly. But, you know, what you're going to get from these slides is, and, you know, everyone will have an opportunity to watch the recording. And this is also an investment summary deck with all of these slides where you can go through these. But this is really just highlighting all of the things that are within proximity to the project. Next slide. You can see that number 1 city to live, work, and play. Number 1 master plan community in Arizona. Number 2 best place to live in Arizona. Top 20 boom towns in America. This is painting that picture that it's in the path to progress. You can see, you know, we talked about the immediate vicinity earlier, but you can see all of the other retail and business and jobs opportunities that are within a 5-10 mile radius. Next slide. They're building a sports complex with pretty significant economic impact, 710 million. Next. This was a really cool one. I just learned about this as we were doing this deal. I'm going to take the 2 minutes to talk about it. But if you haven't heard of the Cactus League, essentially what it is all of these teams on the left do their spring training here. And it turns this area into a bit of a tourism, you know, event space where folks literally are just going to come out here for a few months and watch all of the games that are going on by all these clubs. It's really unique. And then, you know, what says path of progress and money coming to town like a private airport for private jets? $1 billion of annual economic impact.
That was a statistic there that said, like, essentially it's having like the Super Bowl every year. That's the impact of that new Peoria Air Park. It's amazing. 900,000 square feet of office space, almost 10,000 jobs. And this is in Peoria. We're not talking about any other city. It's like right in this where this is happening. So the wealth, the immigration, the migration, the demographics, the economics all speak to how this is the path of progress.
100%. You know, and these are the other things that you see in those types of areas, ones that are going to get, you know, rebuilt, redeveloped, and new development coming in is a new food hall and community space, a revitalized downtown area. You can tell, and, you know, Mike's been a testament to this throughout the presentation, you know, the city has big plans for Peoria, and they're investing their own dollars and partnering with developers to make this area be the next hotspot of the Phoenix submarkets. Healthcare is always a big, you know, job creator, and it's something that we always look at. Almost all of the properties that we've brought to the table for our investors have had proximity to big healthcare centers, and this one's no different. Specifically, this new medical campus coming to Peoria is going to be 100,000 square feet of medical facility, and is really going to be, you know, further bolstering the case for this submarket. And then the last one here is going to be this huge mixed use new retail development, 140,000 square feet, $100 million worth of new buildings, 1,500 plus jobs, and the city's involved for up to $2 million of reimbursements.
So I'll take it from here, Chris. So guys, I'm going to bring it home. Peoria, as well as Phoenix, is close to all these major cities, Vegas, San Diego, Scottsdale. With the tax environment of California, guess where everyone's moving to, right? This is Phoenix is one of the hot spots. Like Utah, Salt Lake City is taking advantage of it. Phoenix is taking advantage of it. There's a huge, migration out of California, and Phoenix is the recipient of that. Phoenix, as a MSA, has been named, one of the best airports, top manufacturing job growth. I'm going to talk to you a little bit about semiconductors and why it's one of the hot spots in the United States for semiconductor companies. It's considered the 5th largest city in the United States. I found that surprising. That was awesome. A lot of it is due to the growth in the last 10 years. Population is booming, 4.7 million currently. They predict by 2040 to have almost 9 million people in the city of Phoenix. Not only is it having the GDP growth as a state, but it's almost 20% larger than it was 5 years ago. And the growth rate of MSA, it's outperforming the United States, one of the top fastest growing metros. As I talked about net migration, it's considered the top state for net migration from 2021 to 2023. It's one of the most desirable places for people to retire to locate to. Businesses are coming in here. And, to buy a home in Phoenix right now, let's assume, you're going to find a $525,000 home. That's the average home price. And the national average is about $419,000. So in Phoenix, it's about $525,000. If you factor in, what it costs to get a mortgage at the interest rates right now, it's about $2,500, $2,700, on the conservative side. Some places may go up to $3,000, while rents are at $1,367, right? So there's always going to be a case to rent, and why rentership is here to stay. There's something interesting about the Phoenix submarket. So water is a big issue. So having access to groundwater is very important. There are Native American reservations all around Phoenix and the Valley. And so there's certain places you're allowed to build, certain places you can't build. And then the last thing is there's mountains. And so that's a natural deterrent to building and growth. And so what that means is there's limited pockets for things like development. This is just emphasizing how many higher educational facilities there are. Job openings as a percentage of employment. Again, a lot of job openings. And the unemployment rate is very low. Here's the top employers. Some of the top ones are education and health, med and ed. That's also the top employers that we see in our tenant base when we attract during our lease-up phases, and also when we've done due diligence on our other properties. We seem to identify pockets of growth where there are a lot of healthcare institutions, and we like that as a tenant base. So the Phoenix of 2008 is a lot different than the Phoenix of 2025. In 2008, it got hammered by the housing crisis, and since then they learned their lesson, and so they've really diversified their base. So healthcare, we got manufacturing, we got finance, we got tourism, construction, retail, education. So it's really diversified. But one of the strongest and most recession-resistant groups is healthcare, and that's where it is. Speaking of healthcare, we're stacking on this topic here. It's a key economic driver. It's about $78 billion of impact for Arizona, and it's one of the key economic drivers for the state. If many of you know the Mayo Clinic, it's based out in Rochester, Minnesota, but they do have a branch in Arizona, and the branch in Arizona by itself has an annual economic impact of 4.7 billion. The whole Mayo system has about 28 billion nationwide, and it provides 13,000 jobs in Arizona. So it's considered one of the best hospitals in the country. And again, it's a driver for growth. So speaking of manufacturing capabilities, so because of the low seismic activity, the friendly tax environment, and sort of the flat lands, they found it to be ideal for chip development. And so Intel, Taiwanese Semiconductor, and all these, this is one of the largest investments in history in Arizona, this $20 billion project where fabrication plant 52 and 62 have come online. Economic impact, it's 8.3 billion. 12,000 Intel employees on these two campuses. They call it the Silicon Desert. And again, this is relatively nearby to all the multifamily we're talking about. Amcor is another one, a $2 billion multi-phase investment. They're producing some of the chips for Apple. Next, this is Taiwanese Semiconductor. They have a huge facility here, 1.2 billion impact, 80,000 jobs to Phoenix. Tourism, we'll talk about that, about 28 billion. Next, you can look at the investment deck later. There is essentially they're challenging Vegas now. So there's sort of a Vegas style resort that has like sort of an all-inclusive experience. It has concerts, all of this kind of stuff into this very exclusive resort, high-end luxury within short driving distance of our property, 32 million. Next to it, they're building a Mattel Adventure Park, essentially sort of like an Islands of Adventure, Universal kind of thing. Both of these are supposed to open in 2024. They're now slated for early 2025. Waste Management Open, the People's Open is one of the most popular PGA golf tournaments. 700,000 people attend every year, $500 million of economic impact. Next, who said Scottsdale and Arizona is not fancy? Now they have the Bentley Polo Championships, apparently. The Super Bowl was held here in 2023, but the State Farm Stadium, tons of sports teams, $24.2 billion of economic impact. Next, NASCAR is a big impact as well. So you can tell this is a sports haven. It's a tourism haven. The airport, Phoenix Sky Harbor, is really ramped up over the years. Now it's become the 9th busiest airport in the U.S. The railway system, $3.96 billion of investment, 80,000 direct jobs by 2031, transporting a lot of things that we know. And this is the last slide before we get into some Q&A here. But Lucid Motors has one of their major manufacturing plants here. They've recently expanded it because they're about to release their new SUV called the Gravity. And it's already has been taking pre-orders in November. This is backed by a Saudi sovereign wealth fund. So there's that Saudi money is coming into Arizona as well. And they expect this to have an economic impact of about 100 million by 2030. So I'll let Chris talk about how we can talk about investments, and then we'll get into the Q&A.
Yeah, how can you invest with us? There's lots of different ways that you can choose to participate in this offering. We covered 1031s uniquely available for this deal, typically aren't available on our traditional acquisitions. You can weaponize your IRA or 401k through a self-directed IRA or a self-directed 401k. You can liquidate assets. You might have cash or savings. Or you can use a trust. Benefits of a 1031, I think a lot of these are obvious. Most folks have heard of a 1031. This is another opportunity. I think a lot of people have unique questions, and when you're choosing to come into a 1031, a lot of it has to do with the debt that you need to match. There's a lot of complex questions. So for 1031, I would say book a call. Let me or someone on my team go through your unique situation, what you're selling, if it qualifies, if the debt matches, and let's see if this is a good opportunity for you. And this is kind of breaks down the process. So seller proceeds, a qualified intermediary basically is almost like a 1031 coach who's going to make sure that everything aligns and that you're going to be able to utilize the project. We can recommend one for you. You can use one that you're already comfortable with. And then in this particular asset, you're going to be put on title on the land. And that's why you're able to come in before it's developed. And you have the disposition of the original property. Next step is your identification period, which are very strict on these days and this timing. So this is one thing that we and the QI will help get right for you. And then the acquisition of the replacement property, and then our disposition, in which you're probably going to be looking to 1031 again, hopefully with us. Okay, I think this is the perfect time to get to our Q&A. Here's a QR code here down in the bottom right-hand corner. This will take you to the book a call link. I know my team's been in the chat dropping a link to book a call. And just so everybody knows, the replay of this webinar, including the FAQ, is going to be sent out within the next 24 hours. So with that being said, let's jump into the Q&A. I'm just going to run through this list, or do you want to run through it, Vic?
Yeah, I'll host it and you guys can answer.
Okay,
we'll go to the slide. All right, okay. So guys, there's a lot of questions that are in the chat and in the Q&A, so we'll hit those up as well, but we'll also hit some of these big ones up. So guys, let's get some. Let me just get some ones. How much equity are you raising, and how does financing look? So people want to just just really answer the financing equity piece. I'll let maybe Ed and Chris answer this one.
Yeah, so with the equity, you saw it in the presentation. It's just over 16 million in equity that we're bringing, into the deal, and the financing is going to be that 70% LTV to the total purchase price or acquisition cost of 65 million. But if you look further in the deck, that'll answer your question. I think this was probably asked prior to us getting to that page.
Yeah, and we've talked about permitting. Michael, you want to talk about when that's going to happen?
Yeah, so we are fully entitled and permits are imminent. So we've already received comments back. Those have been resubmitted, and we're really just waiting for the permit now and the city to finalize their review process.
So in a short while, probably in the next few days, you're thinking. Okay, good. Is GP equity contributed by the sponsorship team or through a different method? So yeah, the sponsorship team is contributing the GP equity. So we'll answer that. Let's see. So people asking about where Peoria Gateway is located in Peoria, and so maybe just the location in general of where the property is located.
Yeah, I'm happy. Sorry. I'm happy.
We put it in the chat. This was asked pretty early on.
Great.
So they should have that data. If not, reach out to us. We'll give you all the details.
Okay. There's a question about the investment period. How long is it? And then will there be any distributions?
So the investment period, like we mentioned, it's planned to be 3 years. The loan is a 5-year loan. So what would cause it to be longer than 3 years is completing the building and going to stabilize and it being a really poor time to sell due to cap rates. And we have that 2-year buffer. So I would say more than likely 3 years. That's what we envision. Worst case scenario, you're looking at a 5-year hold through the loan term. The cash flow, there isn't cash flow in the deal because there's no revenue as you're constructing it. There's no tenants. So I wouldn't expect any cash flow unless we go past the 3 years. If we go past the 3 years and the property is fully stabilized, in that moment, it's going to be timing the best time to exit, and you would be receiving your share of cash flow based off of what a fully stabilized property looks like, which would be, substantial, probably in the same typical 5 to 7% that you'd get in any of our acquisitions.
Okay, we have a smart, very sophisticated investor. What's the yield on cost, untrended and trended, for Michael?
I don't have the trended off the top of my head, but I can get that. I have the yield on cost at 6.8%. Typically, the rule of thumb on that is you want your yield on cost to be about 150 basis points higher than your exit cap. I feel like 200 basis points on projected exit, that's a pretty comfortable area to be.
Awesome. All right, so let's get into these some of these bigger questions that I've tried to hit some of those ones from the Q&A, and now let's just go through this. Why is Viking can you go back to the slide here? Thank you. Why is Viking doing development? So Chris, Viking historically has done value add deals. This is the first development deal. Is there a reason why? Are we shifting strategies? Are we adding strategies? Can you sort of explain that to the investor base?
Yeah, I think it's multifaceted, but I think the most important reason is if you look at what's happened with the real estate cycle, it's pretty clear that there's really great times to buy, and then things get a little frothy and costs get really high, and a lot of people are in the market, and that usually coincides with lower interest rates. And at that point, if you're going to continue buying and acquiring, like Viking's main, mode of business is, you run the risk of buying at the top of the market. What you can shift to, if you're going to plan to be a long company, a long horizon, 10, 20, 30 years, is when interest rates go down and the markets get really frothy and the cost and the cap rates compress, that's when you start developing. And you start developing at that time because it doesn't really make sense to buy at the top of the market, but you can build at the cost that it costs to build. And then you're able to sell into the top of the market. I think that's the way to create a true all-weather strategy for real estate private equity.
That's awesome. Michael, isn't Phoenix overbuilt?
Yeah. So question I get a lot, and the answer is twofold. One, right? That's kind of that snapshot in time. If you look at the snapshot in time, yeah, there's a lot of deliveries that have happened, in 2024, and people are competing. And I think also it's coming off of the fact that 2022 was a feeding frenzy, right? It's just how fast could you increase rates? Coming off of that and looking out into the horizon, the answer is no, right? I mean, if you're gonna ask me today, this very second, yeah, there's a lot of supply that's come on. But if you take and broaden that perspective by a year either way, 2 years either way, the reality is there's a huge housing shortage in Arizona, and it's projected to just get worse.
So Ed, you've built several companies. You've delivered so much development. You've done value add. You've been in the industry for over 30 years. When investors who are used to cash flow first get presented development deals, they may be like, "Oh, there's no cash flow." How have they been able to navigate that framework, and how have they eventually fallen in love with development, and why?
Well, for the reasons that we talked about earlier, why I fall in love with development. As far as the no cash flow, that comes up a lot. And at various firms I've been with, we've had investors that are used to getting monthly checks for distributions, and development does not do that. On some cases, I've seen it happen, but it's very, very rare. And that would be built into your development budget. But lost my train of thought here.
The advantages of development, why
Oh,
is that more attractive sometimes than
yeah, most of the investors, once they see the cycle and they see the 3-year period and we sell one or two, have gotten what we thought would have been, for example, at my previous firm, what we thought was going to be, they didn't want to do it for a long time, and then they did it, and then we sold one, and they loved that so much, we did two more. They loved that, so we ended up doing 10. So we took advantage of the cycle, and the nice thing about having been doing this a long time is you can recognize when the cycles are starting up again. We just finished a cycle. We've been kind of in a 2-year kind of lull because people really can't get anything going. Rates have been high. Rates are coming down. And you can see it in that chart with the snippet, like Michael said, if you expand it on either side, expand it going forward, you'll see that now is a great time to actually start construction.
Okay. Let's talk about the elephant in the room. I know President Trump is about to get inaugurated, and he's talking about tariffs. Doesn't that spell doom for the development industry because of labor, supplies, all that kind of stuff? Michael, I'll let you tackle it first, and then Ed and Chris, you guys can go after it next.
Yeah, I mean, so it's something that it's one of those things that get brought up and creates a lot of interest and commotion, and you kind of wait to see what reality is at the end of the day. You know what I mean? That's what we're seeing a lot of, in the fact that, yeah, you see these tariffs, but in construction, you're still seeing your labor forces are here in the US, right? We're gonna tariff US employees, you know what I mean? And so a lot of that is still residing within the US. We are going to bring some materials from out of the country, and we'll have to kind of deal with that. But what you see is you kind of see these balancing out. I mean, the very first thing that I have to say to that is, it's kind of like let's see, right? But it's something that we've dealt with in the past. I mean, you look at like tariffs and the thought of maybe a little bit of increase in construction costs, which is, your materials are actually pretty minor compared to the labor costs. I mean, we went through COVID, and we went through a period where almost every week, construction costs were increasing $500,000 million on a project, and managed our way through that. So the thought of a tariff, potentially having some impact or not impact, to be honest, it's on my radar, but it's not something that I'm overly concerned about.
And then Ed, I want you to weigh in on this too. You had a really good answer when we spoke about this earlier.
I think it's also mitigated by the fact that Michael's group, Overland, has bought out this project. So all the subcontractors' prices are locked in. They're locked, the contractor is locked into a guaranteed maximum price contract. Obviously, the subcontractors will probably have escalation clauses built into their subcontracts, but we know what those are, and we've accounted for those. So yes, there could be an impact, but it's not going to be anywhere near the impact that people would think. It won't be that significant.
Right. So these are all the ways Viking has sort of thought about it and mitigated risk. And Chris, let's talk about all the risks on this deal and how Viking has thought about it and really thought about how to protect the investment, protect the investors, and protect the project.
Yeah, I mean, I think the first thing that we did was, we spent a lot of time, years even, vetting Michael and Overland Group, and, really dug into their track record, met with him many times and went to visit the property. You know, having Ed on our team who had the development experience, even without someone like Ed, we could still partner with Overland, but we'd be a little bit more at the mercy of them being the expert and us not really having the expertise in-house. Having Ed and 30 years of experience and $1 billion of development under his belt is going to help keep Michael honest and help protect us and our investors. You know, we spent tons of time going over the area. I've been out to the site 4 times, twice with investors and twice with other folks. You know, I think we've really done an insane amount of due diligence on the area, the project, what it's going to be delivering to the broader real estate market. I really think that we're prepared on this one. One thing I want to address from the Q&A, because somebody brought it up, and I understand why it's an interesting question. And it's, you know, we did a webinar on Peoria several months ago, and some of the investors that are watching this have already invested in Peoria. We've raised over $3 million from our original launch. And the reason is with a development deal, we always envisioned doing this in tranches. So it was going to be 5 million, 5 million, and 5 million. In that same moment, we also have our own pipeline of acquisitions. So, you know, closing Avondale, closing Bluebonnet, launching Peoria in the background, we wanted to make sure that we gave a clear head start. And due to the fact that there's no cash flow in this deal, a lot of people wanted really what got mainly filled up in that first early webinar was a lot of the 1031 funds. But it's not that we launched this deal and didn't find success and we're launching it again. It's that we're now closer. We have more information. If you compare the webinars, a lot more information now. Michael and his team have 3 to 4 months of more work towards the entitlements and the permitting. And now Viking's sole focus is on fully funding this deal as we start the year.
Yeah, absolutely. That's a great clarification point. And people are asking about, what about the rates, guys? So the interest rates, the loan, the debt, maybe you can help people feel comfortable about what's going on there. I'll let Michael and Ed maybe handle those.
Okay.
Yeah, I mean, go ahead, Ed.
Go ahead, Mike. No, go ahead.
I was gonna say at this point they're working to our advantage, right? And the fact that as rates continue to come down, we can continue to take advantage of that. And really what we have, I mean, there's been a resurgence in construction debt. So we're seeing a little bit more competition. Our team at Walker and Dunlop is fantastic. And they had just announced to me that they actually, in between Christmas and New Year's, I was talking to them, their team alone in Manhattan closed $1 billion in construction debt between Christmas and New Year's, right? And that's a lot of new debt. And so really what we're seeing is we have multiple deals right now that kind of took the brunt of it, right? We started when SOFR was basically 0, and all of a sudden now our rates increased by 5.5% to what they were at their peaks. And that was hard. And the interesting part now is you're only seeing rates come down. We build in an interest reserve at the very beginning. In fact, it's required by the construction lender. And so paying for all of the interest on the construction debt is built into the cost that you already saw. We're not at the mercy of hoping that rates go down and we'll see, and we have to try and come up with money. The money is set aside day one before we ever even close on the loan to pay for all of that interest.
Yep.
Great. Okay. So, and the last one, Ed, is lease up plan. This is, lease up risk is always a challenge. In fact, I've seen some developers who are not very good at management. And in fact, we've taken advantage of that by buying deals at a really good basis because they've had challenges leasing up. Ed, how do you plan to help make sure that never happens to Viking and we're really on point with lease up?
Well, the beauty of that is that's where I get to put on my asset management hat. So I'm excited to do that. Managed a ton of lease ups over the years. It's critical to find a management team that is good at doing lease ups. That's more nimble, more lease up focused. I have 3 in mind that I'd like to use. One of them is the one that I've used for over a decade prior to coming here, and the other would be the one that we've used here internally, looking at that one. But we'll probably bring a management company on in the next month or so to kind of advise as we go, and then we'll see where we are. But yeah, lease up is critical. A lot of times, what you really don't want to happen is you don't want the lease up to get delayed to a point where it's really going on past a year from the first delivery of the buildings. Ideally, you'd like to get it leased up, in that first year. It's sort of the rule of thumb. And some firms are really good at that, property management, and some aren't. And I mean, I'm very good at telling which ones are.
Awesome. Let's go back to the previous slide. I want to give people a chance to book a call, connect with our team. You can text Peoria at that number, 826-205-0259. You can send us an email. You can scan the QR code, book a call. That's the best way to get your questions answered. I know we did our best to try to answer as many as we could, but we're on standby. We'd love to help you guys, and this is a good, strong way to start the new year with a powerful deal like this. It will get fully capitalized soon. So I would love for you guys to join us on this one. And obviously with this powerhouse team, you're going to be in very good hands with people like Overland, with Ed, with Chris, and the rest of the team here. So book a call, get your questions answered. We also have a podcast, the Viking podcast, called Wealth Unfiltered. My good friend Chris is one of the hosts, along with Samantha Paranello. And there's a QR code to take advantage of one of their recent episodes, which is Advantages of a Development Deal. Chris, anything you want to say about that? And then we'll let people off into the evening.
Yeah, absolutely. And Michael also joined this and was interviewed for this podcast. And really the idea here is to help our internal investor base that's used to investing in acquisitions and really understand the juxtaposition, the differences, and the advantages of why they should give this a shot and bring it into their portfolio. So anyone that's interested in taking a listen, QR code's here. And we have a whole slew of other podcasts that are coming out every week.
All right, guys. Thank you again for your attention. I really appreciate you guys joining us for this webinar. Michael, thank you. Chris, thank you. Ed, thank you. Thank you, investors, for your trust and support. We really appreciate you guys. We couldn't have got here without you, and love to hear you guys on a call. And we'll see you guys soon. Replay will be coming out in the next 24 hours. Thank you so much. Have a good night.